Hello, beautiful people, and welcome to a brand new edition of the ITU Forex class. In this week's edition of the class, we're actually going to be talking about how to identify liquidity zones. Okay, so this is a topic which is kind of an intermediate topic. Okay, it's not among the advanced topics, I would say, because we're just scratching the surface, obviously, and it's not it's not the beginner kind of topics you're used to, okay? But it's something that is definitely going to help you improve how you identify, how you manage your trades. Not identify your trades, but how you manage your trades, okay? So without wasting any more of your precious time, let's dive right into it, okay? So to kind of make it easy for you to understand what we're going to be talking about today, okay, let me give you an example. Usually what we have is, in fact, let's not usually, let me not say usually what we have. Let me put it this way. In order to make money in the Forex markets, what we're trying to do is we're trying to buy an instrument when it's cheap, okay? And then sell it when it gets expensive a little bit. And then bank the profits between that, the price where we bought it at and the price we ended up selling it at, if we went long. And since Forex is not like the stock markets where you're only limited by, going long on any tradable asset, you can also short. There's also a flip side to this. So you can short an instrument when it's expensive and then cover that short trading position when price falls, and then you bank the profits. Okay. So in a visual representation, that would look something like, let's say price makes a high, it pulls back a little bit, then it makes another high, and then it pulls back a little bit, and then it makes another high. So ideally, you would have want to, get in long on this particular instrument when it was somewhere around here. And then when it reached, maybe here or whatever price level is higher than the price level where you got in at, that's where you're going to take your profits. On the flip side, assuming you were short on this currency pair, okay? So you would have sold it when it was, a little bit high. And then when it pulled back down, you would have wanted to maybe cover your short, okay? And bank the profits you made from that trading position. Now, if this was the case, usually, then obviously there's a price level where you would get into the market with your trading position at. And then there's also two possibilities, two likely exits that you'd have for your trading position. So it's either price is going to, let's say you got in somewhere around here. So it's either price is going to go up higher than the price where you got in at, so that you're actually going to exit that market with the profits from a trade, or price is going to go lower than the price where you entered into the market with the trading position at. And in that case, you'd end up taking a loss on that trading position. This is the basic things that, we do when we go trading, okay? So, I think I don't want to clean this up. So with this explanation out of the way, let me quickly go get out of the whiteboard, and then we'll continue with our explanation, okay? So when we're talking about liquidity, in particular liquidity sweeps, this is one of the concepts that traders tend to use to define what manipulation occurs in the market by the big players, okay, in an attempt to get their orders to get filled. Let me put that in plain terms for you. So when me or you, little retail traders want to get into the market with a trading position, let's say we just identify our trade setup using simple methods. Okay, in this case, let's use a simple little example of, let's say you're trading based on support or resistance or whatever the case might be. And so you identify the resistance area and you saw price struggling to break above that resistance area, followed by a bearish engulfing candlestick or whatever the case might be. And so when you saw something like this, which is, after the rejection here and price from this bearish engulfing, you could have taken a short trading position with your stop loss being above this price level that price struggled to break above. And with proper risk management, if you're risking 1% of your account's capital, maybe you're aiming to make a profit of 2 or 3% that amount. Basic things, okay? This is basic trading 101. So if you got into the trade at this price level and then price, for whatever reason, didn't move in your favor, but then it immediately moved against you to come to your stop loss level, then you're actually going to get out of the market with a loss on that trade. On the flip side, if price moved in your favor, depending on the price level where you're going to close that trade at, you're going to end up getting out of the market with a profit from that trade. Now, for retail traders like you and I, getting into the market with a trading position is as simple as clicking the buy or sell button or even placing a pending order. Okay? The market is so liquid that our trading positions are almost non-existent in the market. So if we wanted to get into the market with the trading position, it's nothing. We just click on the buy or sell button and we get into the market. But this is usually not the case for institutional traders. And the reason is because institutional traders are managing billions of dollars. Billions of dollars. So it's not as easy for them as it is for you and me to just spot a trade setup and then place a trade and get into the market with that trading position. Because most of the times when they spot a trade that they want to place, when they get into the market, because of the sheer volume of the trades that they are placing, that would cause the market, if they're going long, to rally very, very fast, okay? Or if they're going short, to really fall very, very fast. And so when it falls very fast and all of their orders have not been filled in, let's say they've made their risk management calculations, okay? And they've realized that on that particular trading position, maybe, they want to, because they're managing billions, obviously, hundreds of billions. So let's say they want to risk, let's say 1 or 2 billion on that particular trading position, which in the Forex market is actually nothing, okay? Because this market makes a daily turnover of trillions of dollars, okay? This is just to make an example that would be easy for you to comprehend, okay? So let's say in our minds, placing a trade risking a couple $1 billion is a huge thing, which it is. But again, this is the Forex market, so it's not that much, okay? But let's just try to pretend that it's a huge thing, okay? In this case, if they were to enter this trade, okay, and then they wanted to risk all of that, so if price maybe moved against their position to arbitrary price level, all of that amounts that they risked is going to be lost. Now, in this case, if they placed that trade, but because of the sheer volume of the trades they placed, because they're risking billions on this trade, it so happens that, even if you're trading with 100 lots, for you to actually finish placing, because that's like the max, okay, in MT4, MT5, you can place a trade with more than 100 lots. So if you want to be risking, a couple billions, and that particular, after working out your position sizing, it shows you that you're supposed to be placing the trade with like 2,000 lots, then obviously you're going to be placing a couple hundred lots trades, okay? So if you do that, and in the midst of placing that, price now, because of the sheer volume of the order that you're placing, price now starts moving away from the entry level, which was ideal for you. Then if you continue placing the trade, let's say you place the trade, the initial portions of the initial parts of the trades, you placed it somewhere here. And then as you're placing the remaining ones, price came all the way down here. Then at this point, it's no longer favorable for you to place this trade. Because if you did this, then your average order size will be very, very bad, and now you need price to move even further down before you can even make a profit. Talk about to break even, talk about making a profit. And so because of these limitations, usually institutional traders like, the big guys, they don't trade the way you and I trade. You and I could just do a little bit of analysis and then identify the level where we want to get into a trade with and just place a trade. And because we are not trading, that huge amount of money, it's easy for us to get in and get out with a click of a button. But for them, they have to think of ways to identify price levels where retail traders like you and I are likely going to be, having a lot of stop losses or a lot of pending orders or a lot of all of those things, so that if they push price to that level, they are going to liquidate our positions and use that. Let's say when they are selling, we are buying. And when we're buying, they are selling. So they will try to push prices to levels where we're doing the opposite of what they want us to do. And so when they push prices there, we are going to be getting out of the market while they are going to be taking our positions. To make this clear for you to understand, this is represented in a way like, let's say you identified that, okay, price came all the way down here. It came all the way up here. which is a classic resistance because it came here, it spiked, it couldn't go any further, and then it pulled back down. Okay? Now, for a normal, retail trader, this would be a cue to say, okay, if price got rejected around this area and now it's coming back to this area and it's still getting rejected, then this would be a good trade setup to take. And depending on your exit, yes, this is a good trade setup. You might place the trade here with a stop loss somewhere around here. Okay? But then this is where that manipulation comes in, because now let's say you place this trade and you're aiming for a 1:5 risk to reward ratio, for example. You can see that obviously after you got into the market with the trade, price moved a little bit in your favor. But then before it continued moving, just imagine that, a lot of traders out there who trade price action just like you, and support and resistances or whatever the case might be, they took the same trade that you took. And so they sold here and their stop loss is here. So if you sold, what is your stop loss? When your stop loss is placed here, what is it going to be? When you place a sell trade here, your stop loss is going to be a buy trade. So when price comes all the way up here, for you to close that sell trade that you did, you'd have to buy back. Now, let's say the same trade setup that you saw, the institutional traders saw it. And so they want to get a piece of the pie. But remember, they cannot just place a trade like you and I by just clicking a button and, because they're trading large amounts of money. And so they're going to target these areas where retail traders who got short on this trade, just like you and I, have a lot of their stop loss for their trades. And so you can see that when price starts moving like we want it to, obviously the big guys are going to try as much as possible to push prices higher, not because they want to go long, but because most of the orders that they want to get filled so that they'll get their entry the way they want it to will be triggered by the stop losses of the people who enter the retail traders who enter trades here, short trades here. And so they'll push prices high, and then you see more often than not is after price has been pushed to take out our stop losses, that price will now move in the favor that we wanted it to do. And this is exactly what you see here. Now that you understand the concept, you're going to see it a lot of times on the charts. You're going to see it a lot. Another example of this is you can see that, let's say this is just another trade setup, okay? Let's say this is another trade setup. Let's say you identified that, okay, price is getting rejected around this area, okay? And so you decided, okay, you know what? I'm going to go in long here. And so you saw this bullish engulfing candlestick and you thought to yourself, okay, it looks like the bulls are stepping into the market and this is a good entry level. This is not bad, because when you actually look at this level, you see that price has tried to break below this level multiple times. You can see that by the wicks of these candlesticks. So price has pushed and tried to break below this level multiple times, but it failed to do that. So after seeing a bullish engulfing candlestick like this is literally telling you that there's a lot of strength in the market. And so taking a long trade here is not a bad thing, okay? Actually, it's a very good thing if you're doing proper risk management. But then, remember what I told you about liquidity. You and I can just identify this trade setup and place a trade. It's nothing, because we are not trading, all that huge amounts of money. But for the institutional traders, most of the times, they can't do that. They don't have the luxury to do that because they're trading huge amounts of money. And so they would need our stop losses to get triggered for their trading positions to get opened. Okay? And so let's assume I placed a buy trade here, and a lot of other retail traders saw what I saw, and they also placed a buy trade, and their stop losses were somewhere here. Now, look at exactly what happens. After we get into this trade, price starts moving in our favor, but it doesn't continue moving. It just starts to stall. And then out of the blue, price just, the big players just push prices down to trigger most of our stop loss. The traders who went long, to trigger most of our stop losses so that they'll get into the market with the trading position, which is what is called a liquidity sweep. And then after this happens, price now goes up to do the move that we wanted it to do. So you can see from these two examples that I've shown you, this does happen a lot of times. And this is one of the reasons why you see a lot of traders, when they identify support or resistance or whatever method they are using to identify their trade entries and exits, they will not place the trade immediately. They will first wait till liquidity gets swept, and then they'll know that the big players, because they are the ones who usually cause the move, the big players are in the market now, and so they'll place their trade after the liquidity sweep. So you see, here, let's say this is a resistance. Most traders will say, okay, you know what? I'm not going to place this trade until I see that the big players have pushed prices up and it gets rejected and it starts to move in the favor that we want it to do. And now I know the big players are in, so I'll take the trade along with them. Again, let's say you saw this bullish engulfing, but you decided, you know what? There's a lot of liquidity. If traders took this long trade, lots of them will be having their stop losses here. So if I don't see the big players coming with their trades and take out the stop losses and push prices to the opposite direction, I'm not going to get into the trade. I'm waiting for a liquidity sweep. Okay, so I hope you understand what this whole liquidity sweep thing is. So just like I explained to you with these trade examples, liquidity sweep is a liquidity sweep is a market maneuver where a price surge or drop intentionally moves beyond a key support or resistance level to trigger the pending order and stop losses from other traders, which was exactly what I explained to you here. So this is a resistance area. And you could see that some traders would have, after seeing this price rejection, would have entered into a trade around here. But then price didn't just started moving down. After price, we got rejected here. And this is why you could see that price started moving down a little bit, but then it moved up, swept all of the traders, most of the traders who placed a very tight stop loss above this resistance area when they got short around here. And then you could see that price just moved down immediately after that happened. So this could be kind of termed like looked at as a manipulation, because if price really wanted to move down, which it really wanted to, it would have just, after getting rejected here, just gone down. But you could see that a lot of traders, it was like teasing traders. He wanted to go down, some would get in, play stop losses, wanted to go down. But then when a lot of orders were aggregated around this area with the stop losses and whatever the case might be around here, the big boys just pushed prices up, stopped everyone out, and then they got, they just pushed prices lower. I'm saying it this way, making it look simple, but it's a little more complex than this. But in essence, this is just what liquidity sweeps are. And like I told you, it's not as if you need to understand these things because, there's somebody always trying to taunt you or whatever the case might be. No, you could use this to your advantage. What do I mean by you could use this to your advantage? If you know that most of the times, these big players, which are the guys who cause the big moves in the market, if you know that most times before they, push prices in one direction, they usually tend to just cause price to just spike a little bit before it starts moving in the direction they want it to move. So in this case, let's say we had a support here, which is obviously what we had. When price came from all the way up here, it didn't stop at anywhere, considerably until it reached somewhere around here. And so when we got this rejection, some traders might also say, you know what, with this pin bar formed here, and then it looks like price is struggling to continue moving down. Some traders would have just gotten into a long trade around here, waiting for prices to move up. But what happened? You can see that price just moved down, barely, stopping the people who placed stop losses right below this level, barely stopping them out, and then it moved up. So this could also be looked at as liquidity sweep. Okay? So you could use this to your advantage in the sense that if you're trading with support and resistance or price action or anything like that, you could say or you could decide that part of your entry rules is you're not just going to blindly get into a trade when you spot support or resistances. You're going to wait until the big boys stop the, push prices to stop the people who took trades early. Until they push prices to stop them out, you're not going to get into a trade. And so if that was part of your trading plan or your trading regimen, then when you saw this happen, price never broke above this high, so you wouldn't take a trade. You'd wait. Price came here, again, it didn't break above this high, you wouldn't take any trade. Until you saw that price stopped everybody out, and you saw this big bearish engulfing candlestick. Now you know that the big boys are in, and so you could take your trade here, risking one to make 2 or 3 or whatever the case might be. The same thing. After you saw that price was struggling to break below this level, and you saw the formation of this bullish engulfing candlestick, again, instead of just blindly getting into a trade after spotting this bullish engulfing, you would wait for price to, the big boys to push prices lower to stop most of the guys who got into the market with the long trade here. And then when they did that, you could see that this we got price rejection and the strong bullish engulfing, you could take a long trade here, ride it up. You could keep doing this. So in essence, you could use the liquidity sweep phenomena to your advantage, in the sense that you're not going to take any trade until price clearly sweeps liquidity on the level that you're looking to take a trade from. If this was the level you wanted to buy, you will not buy until you see price take out their stop losses and then get rejected, and that's when you take your trade. You wanted to buy here also, you wouldn't buy yet until you see price take out their stop losses, get rejected, and then you place the trade. Now, again, we've come to this part of the class where I usually like to draw your attention, because when I use these examples, I usually show you examples of trades that worked. Does this mean just because you've learnt about liquidity sweeps that if you go to the market and you try to use them now, you're never going to get losing trades? Of course not. Of course not. I keep saying this time and time again in these classes. If there's one thing I want you to go with, to always remember me by, or to always remember that you've extracted as value from these classes, is the fact that the financial markets are uncertain. And because of that uncertainty, the only way you can protect yourself is by opening your heart, completely accepting the fact that no one, no matter how good the trading strategy you learn, or no matter how they trade the market or whatever the case might be, no one knows with 100% certainty what the market is going to do next. And as a result of this, this makes it extra important to practice sound risk and money management, because if you don't know with 100% certainty what the market will do, then if you're risking what you can't afford to lose, there's a high chance that you can actually end up losing that thing. But if you've come to terms with the fact that you're not going to take winning trades 100% of the time, that would make you understand that risk management is important. And as a result of this, you'd firmly internalize that I know that I'm going to win some trades and I know that I'm going to lose some trades. But at the end of the day, if I practice proper risk management, and when I say proper risk management, I mean you're keeping your risk consistent. If you're risking 1% of your trading account capital on each trade you take, stick to it. If you're aiming for a risk to reward ratio of maybe 1:2 or 1:3, make sure on average, always, whenever you risk something on a trade, and if it doesn't work out in your favor, you're only going to lose 1% of your account's capital at bare minimum. And if you are aiming to make a profit, you're aiming to make at least 2 or more times what you're risking. So if you're risking 1%, you'd be aiming to make a profit of 2%. The reason why this is important is because if you plan your risk management in this fashion, if you take a large number of trades, like 50, 100 trades, or whatever the case might be, even if you end up losing some trades, which is very, very likely, if you are risking, taking a 1:2 risk to reward ratio trade, for example, even if you lose 50 out of the 100 trades you take, you'd still end up being profitable. Okay, so that will ease the pressure of you having to take trades that end up being winning trades on you. And if you're even aiming for a higher risk to reward ratio, like 1:3, for example, then that would even take more of the pressure off, because now, even if you lost 60 out of the 100 trades you took, since you're aiming for 3 times what you're risking on each trade you take, you're going to end up being very, very profitable. The higher the risk reward to risk ratio trades you take, the easier it will be for you to be wrong and still make money after taking a large number of trades. But you have to let the edge play out. That's where the law of large numbers come in. Okay? So the reason why I'm restating this is because you might think that, okay, now I know what the big boys are doing. I'm going to be taking trades when they're taking trades. And so because I know, after there's a liquidity sweep, most times it's going to continue, I'm now going to risk all of my account, 50% of my account's capital on the trade, because it has to work out. No. If you do that, you'd be very, 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 very surprised by what the market will humble you by. Okay, so stick to proper risk management. Whatever concept you learn, know that even though it works very well, it's not going to work 100% of the time. And that's why you need to practice sound risk and money management to protect yourself. Okay, to protect yourself. With that being said, this pretty much brings us to the end of this week's edition of the ITU Forex class, okay, which has been quite one to be an eye-opener, especially for traders who are completely new to all this smart money concepts and all of this, okay? Now, what I want you to do is, on your own, go and look at this on the charts. Go and look at this on the charts, okay? Picture them for yourself and, try to look at times when it worked. Try to look at times when it didn't. Backtest it if you can. If you have a backtesting software, do as much as you can to prove the concept to yourself that it actually works. But it doesn't work in isolation. It works in conjunction with proper risk management and having the right mindset. So if you encounter like 4, 5, 10 losing trades in a row, you're not just going to say, okay, you know what, this liquidity sweep thing doesn't work and I'm going to dump it. No. In fact, don't try it out on a demo account or a live account with real money first. Test it out on a simulation account. If you have a backtesting software, test it out there. If you don't, just go back on historical data and try to see when it worked out and when it didn't. And try to assume that, you're placing trades with risking 1%, aiming for 2 or 3, and, try to see it work live in your before your eyes, okay? Okay, and with that being said, again, this brings us to the end of this week's class, the ITU Forex class, and I would like to draw your attention to the fact that the concepts that we teach in the ITU Forex classes, most of the times are tools and techniques and trading strategies, resources that are meant to help you to trade using manual trading strategies. Okay, but then we also have a portion of the company where it's dedicated to bots and expert advisors, which are designed to trade on your behalf. So they would identify the trade setups for you. Most of the times, they would identify the low risk, high probability trade setups for you. And if you follow our risk recommendations and use proper risk management, they are going to identify the setups and do the proper risk management for you and help you to start earning while you're learning. Okay, so if you're interested, please reach out to us in the comment section or any of our social handles, and we'll be more than happy to walk you through exactly how to set everything up, how to, get up and running in no time, how to start earning while you're learning. Okay, so if you're interested, again, please don't hesitate to reach out to us. Once again, thank you for taking time out of your busy schedules and coming to these classes. I really appreciate them. If you have any questions, don't hesitate to leave them in the comment section or the video's description where you can. Okay, so once again, I look forward to seeing you guys in next week's edition of the ITU Forex class. God bless you and have a wonderful rest of your week. And please, don't just come to these classes and just watch these videos passively. When you learn, take notes, go out there, practice them, rehearse them. Practice makes perfect, okay? So please go out there and all of the concepts you're learning, try to improve. There are lots of things that we talk about here. So try to learn 1 or 2, practice 1 or 2, and the ones that really resonate with you, incorporate them into your trading regimen, into your trading plan, into your trading strategy, or whatever the case might be, okay? Don't just come and then watch passively and do nothing and just feel like, you're doing something while you're not doing anything productive, okay? So please try them out, test them out, and then improve. If you have any questions also, reach out to me, and hopefully I'll try to assist you as best as I can, okay? To make things clear. Once again, enjoy the rest of your week, and God bless you. Cheers.